Hi there, hope you're well. Can you believe it's almost June, nearly halfway through the year? How quickly has that gone? Leading up to 30 June is a great opportunity to think about things you can do which might be able to help save tax or build wealth. Today we're going to chat about a few ideas for you to think about. The first one is superannuation. You may want to look at actually adding some extra money to your super. So if you earn less than 57,000 per annum and you add after-tax dollars to super, the government may also make a co-contribution on your behalf of up to $500. Doesn't sound too bad, does it? Now, the co-contribution amount depends on your income and how much you contribute. To get the maximum co-contribution of $500, your income is going to need to be less than roughly $42,000, and you'll need to add $1,000 to your super. If your income's between $42,000 and $57,000, the amount the government puts in will reduce. You'll get less than that $500. If your spouse is not working or is earning a low income, you may want to make an after-tax contribution for them. And that can actually help to reduce your tax. So the maximum tax offset is $540, and you could receive that if you add $3,000 to your spouse's super fund and their income is $37,000 or less. Again, if their income is more than $40,000, then this strategy isn't going to be helpful for you. Finally, you may want to look at making extra contributions to your super fund from pre-tax dollars. Now, if you're earning $100,000 a year, this could save you $1,700 in tax by adding an extra $10,000 to your super. Just keep in mind the most that you can have go into your super in this way is $27,500 each year, and that includes any money that your employer's added to super as well. Also, just keep in mind that super funds get really busy leading up to 30 June, so if you're going to make an extra contribution to your super, do that well and truly before 30 June. Another way to boost your tax refund is to pay for any expenses that may attract a tax deduction before 30 June. This can be a really good option if you're thinking that your income is going to be lower next year. So some things to think about here: you might want to pay for your income protection up front, you might want to make some extra donations to charity, or maybe claim some work-related expenses. Now, if you're unsure about what work-related expenses you can claim, the tax office has a really good list there. Just remember, you can't get reimbursed for those expenses, and the expense needs to relate directly to the income that you're earning. A lot of people get these deductions wrong. It is a focus area for the tax office. Keep in mind, if you're claiming more than $300, you're going to need to have written evidence, usually a receipt. Now, if you own an investment property, you may want to prepay some property-related expenses, and that could help you with a tax deduction as well. Maybe you want to pay for next year's building insurance all in one go. Or if your property needs repairs or maintenance, you might want to do those between now and 30 June. Keep in mind, for repairs and maintenance to be tax deductible, you can't be improving the property. So replacing carpets with tiles, that may be viewed as an improvement, and that wouldn't be tax deductible for you. Also remember, whilst the tax deduction is nice, don't spend money just for the sake of it. For every dollar that you spend, you're probably only going to save tax at maybe 30 or 40 cents. Now, if you own your own business, you may be able to save some tax by buying an asset like a car or equipment for the office. And there's some special rules in place at the moment called temporary full expensing. So if your business has aggregated turnover of less than $5 billion, I think most small businesses would fit into that category, you may be able to claim a full deduction for those items. You need to keep in mind that the asset needs to be installed or ready for use before 30 June 2023. So, if you order a car today and it doesn't arrive until September, that is not going to help you with this year's tax, and these rules are changing from 1 July. So have a chat to your accountant about that if you're not sure. Now, if you've sold any assets like shares and an investment property and you've made a capital gain, great work. You're probably going to have some tax to pay. One option to think about is if you have investments that are other investments that are performing poorly, you may want to sell them before 30 June and crystallize that loss. And that loss can help to offset the gain that you have. Now, keep in mind, selling an investment at a loss, not always a great idea. So you certainly wouldn't want to be doing that just to avoid tax. And you also need to be careful that you're not selling that asset and then just buying it back the next day. The tax office don't get too happy about that. Lots of good stuff here today. If you're not sure about anything, please feel free to give us a call. Always happy to help. And until next time, stay safe and stay well. Cheers.